Hello everyone and welcome to This Week in the Markets. So last week we had the release of the September's unemployment report, which is quite surprising in many ways. And also Alcoa kickstarted the earnings season on Tuesday. So we'll discuss a bit about that and what we expect from this upcoming earnings period. But first, I'll just go through our disclaimer. So information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regards to your objectives, financial situation, and needs. So the big news last week was the unemployment report. This usually gains a lot of market attention because it is an important component of the economy and also part of the Fed's decision-making process. The Labor Department reported that non-farm payroll increased by 114,000 last month, which is more or less in line with the consensus. The positive news was that in the revision of the numbers, because generally the first estimate of the non-farm payroll tends to be rather inaccurate and prone to multiple and large revisions. So rather than focusing on the first estimate, we usually find it more helpful to look at the size and direction of the revisions to previous numbers. In that sense, the report on Friday was actually quite bullish as August jobs were revised upwards by 46,000 to 142,000, and July jobs were also revised upwards by 40,000 to 181,000. So that is 3 solid months of above 100,000 jobs creation. To be sure though, this is still not a figure that ensures a robust economy, as it is estimated that 200,000 jobs at least a month is needed to keep in pace with the population growth. But still, this is far from the doom and gloom economy that many have been led to believe. The other surprising, although a little bit confusing factor was the unemployment rate, which fell unexpectedly from 8.1% to 7.8%. There were many conspiracy theories around this, saying how Obama used his way to manipulate the figures to gain an edge in the upcoming election. We are not too interested in conspiracy theories ourselves because whether it is true or not is hard to prove and it will not really help us with our trading. What we do note is that the household survey, which is the one used to calculate the unemployment rate, recorded a surge of around 580,000 part-time jobs. We do not know the reason for this sudden surge. It could be that people are getting desperate and just accepting any jobs available to them, even part-time ones. But whatever the reason is, the important thing is to see whether or not these part-time jobs will be converted into full-time jobs in the next few unemployment reports, or will it fade away, in which case it will be useless for us. We'll hold out our verdict for this and we'll just see what the next report will bring us. So Alcoa kickstarted the earnings season on Tuesday with report of its third quarter earnings. Sentiments are extremely bearish going into this earnings season, with many expecting it to be one of the worst earnings seasons since 2009. This is partly because of a lot of companies' pre-announcements, which have mostly came in more negative than positive. Analysts also downgraded revisions to earnings more than they have upgraded the revisions by a large margin in the last few months. So that has also added to the bearish sentiments. Currently, the expectation is that the S&P 500 earnings will fall between negative 1.2% to negative 2.7% in the third quarter. However, with the earnings report, often it is not the actual number that moves the stock prices, at least not in the short term, but rather what's important is whether earnings are better or worse than expected. So with expectation already set at such a low level, we would actually not be surprised to see earnings easily beating expectation, and that again bears might not get what they are expecting. In fact, Alcoa's third quarter earnings report actually exceeded most analysts' expectation both in its earnings per share and in revenue. But again, the company cut its forecast for aluminium and citing further slowdown in demand from China, and that has caused its stock price to fall sharply yesterday. So while we think the current market sentiments are too pessimistic given the performance of the economy, we are not totally ignorant to the warning signals given by companies such as Alcoa yesterday and by FedEx and Caterpillar earnings earlier in the month. And last week we also have IMF who joined into the warning to cut global growth rate by from 3.5% to 3.3% for the current year, and also warned that the risk for serious global slowdown is alarmingly high. If we consider the breakdown in this next chart of their forecast, The IMF does not share the same pessimistic view on all countries. In particular, the GDP growth for US this year was actually revised upwards, with the chance of a recession, as we can see on the right hand side over here, is actually being cut by 4%. However, it is also obvious that there are serious risks for the Eurozone, whose growth have been forecasted to go further into negative territory, and the chance of a recession, they're almost doubling to 84.6%, which is pretty much a near certainty. So as we said before, the euro remains a wild card on our list, and the problems that could be resolved or could continue to drag on and worsen, we just don't know at this stage. So our preference is to focus on US exposure and try to reduce our exposure to the Eurozone economy. Well, that's all from us today. We'll have another update for you next week. Until then, on behalf of the Trading Pursuits team, we wish you all profitable trading.